Okay, so chapter 11 exercises. So the presumption here is that you have already listened to the chapter 11 lecture PowerPoint. If you have not yet done that, please go back and do that first and then come back and listen to this one and hopefully it'll make some more sense to you. All right, so let's dive in. Exercise 11.2. So Rodriguez Corporation issues 20,000 shares of common stock for $180,000 cash on February 20th. Prepare the journal entries to record this event under each of the following separate situations. So stock has $3 par value, so let's do that one first. So if they issue 20,000 shares for $180,000 cash on February 20th, we would record a debit to cash for the amount of cash received, $180,000. A credit to common stock for the par value, so that'd be your 20,000 shares times $3 par. So we have a credit for $60,000, and then we have paid in capital in excess of par common stock for $120,000. That would be equal to the the difference between the par value and the amount that they actually received in cash. And option number 2, or situation number 2, the stock has neither par or stated value, so we're just going to record a debit to cash and a credit to common stock for the $180,000. And in situation 3, it has a $6 stated value, so our cash is still going to be a debit of $180. We're going to credit common stock stated value at the $6 per share times the 20,000 shares. So that's $120,000. And then the excess gets put to paid in capital in excess of stated value, common stock. So that's $60,000. All right, same problem, different numbers. Why don't you take a minute, pause the recording, work through it yourself, and when you're finished, you can resume the recording and we can go through it. All right, so Rodriguez Corporation issues 19,000 shares of common stock for $152,000 cash on February 20th. Prepare the journal entries under each of the following situations. So if the stock has a $2 par value, we're going to debit cash for the $152,000. We're going to credit common stock equal to the par value times the number of shares, so 2 times 19,000, 38,000, and then the difference gets put to your paid in capital in excess of par common stock for $114,000. In situation 2, there's no stated or par value, so you just have a debit to cash and a credit to common stock. In situation 3, if the stock has a $5 stated value, our cash is still going to be $152,000. Our common stock will credit equal to the stated value times the shares, so 19,000 times 5. And the difference gets put to our paid in capital in excess of stated value, common stock. So keep in mind, in situation 1 and 3, there is no difference in the entry, it's just the words. So whether it's par value or stated value, the entry is still the same. Okay? All right, exercise 11.3. So prepare the journal entries to record the 4 separate issuances of stock. So in number 1, the corporation issues 4,000 shares of $5 par value common stock for $35,000 cash. So we're going to debit cash for $35,000. We're going to credit our common stock for the par value, $5 times 4,000 shares, or $20,000. And then the difference is our paid in capital in excess of par, $15,000. In situation 2, corporation issues 2,000 shares of no par value common stock in exchange for the promoter's efforts, estimated to be worth $40,000. So we'll have a debit to organization expenses of $40,000, a credit to common stock for the par value, $1 times 2,000 shares, and a credit to paid in capital in excess of stated value of $38,000. So in situation 2, what they're doing is they're issuing stock to the promoters that are helping them to promote the stock. And so that just gets debited to organization expenses. Okay. In situation 3, a corporation issues 2,000 shares of no par value common stock to its promoters in exchange for their efforts estimated to be worth $40,000. But this time there's no par value. So you just have organization expenses of $40,000 and you have common stock, no par value, $40,000. In situation 4, corporation issues 1,000 shares of $50 par value preferred stock for $60,000 cash. So we have cash of $60,000, debit to increase it, and then we're going to credit preferred stock for the par value, 1,000 shares times $50. So we have $50,000 of preferred stock par value, and then you have paid in capital in excess of par for preferred stock for the difference, so your debits equal your credits. And in this case, we need a credit of $10,000. All right, same problem, different numbers. Why don't you take a minute, see if you can't come up with the journal entries yourself, and then when you're finished or you get stuck, resume the recording and we can go through it. All right, so in situation 1, corporation issues 6,000 shares of $5 par value common stock for $54,000 cash. So we're going to have a debit to cash for $54,000. We're going to credit common stock for the par value, $5 times the 6,000 shares. We're going to also credit paid in capital in excess of par for the difference between the cash we received and the par value stock. So in this case, $24,000. In situation 2, the corporation issues 3,000 shares of no par value common stock to its promoters in exchange for their efforts. So we're going to debit organization expenses, $63,000, and we're going to credit our common stock for the stated value of $1 times the 3,000 shares. So $3,000 of common stock, and then we're going to have $60,000 of paid in capital common stock. In situation 3, the corporation's issuing 2,000 shares of no par value common stock to its promoters in exchange for their efforts, estimated to be worth $30,000. So they're going to have organization expenses of $30,000 and common stock of $30,000. There's no par, so there's no paid in capital in excess of par because par doesn't exist. Okay. All right, in situation 4, corporation issues 2,000 shares of $50 par value preferred stock for $130,000 cash. So we're going to debit cash for $130,000 to increase it. And then we're going to credit preferred stock for the par value, $50 times 2,000 shares, or $100,000. And then paid in capital in excess of par value for preferred stock. We need a credit of $30,000. Okay, so hopefully you did well on those. Let's move on to the next. All right, exercise 11.4. So Sudoku Company issues 7,000 shares of $7 par value common stock in exchange for land and a building. The land's valued at $45, the building at $85. Prepare the journal entry to record the issuance of the stock in exchange for the land and the building. Well, we're getting land and building, right? So in order to increase those accounts, we're going to debit land for $45. We're going to debit building for $85. They tell us that the stock has a par value, so we're going to credit common stock for the par value, 7,000 shares times $7, or $49,000. And then our difference to make our debits equal our credits is going to go to your paid in capital in excess of par. And in this case, we need $81,000. Okay? Same problem, different numbers. Why don't you take a try at this one? And when you're finished, we can go through it. All right, so Sudoku Company issues 26,000 shares of $7 par value common stock in exchange for land that's valued at $243,000 and building that's valued at $375,000. Prepare the entry. Well, we know we're getting land and building, right? So those assets were increased with debits. So you increase land with a debit of $243, increase building with a debit of $375. We're going to increase our common stock for the par value. So our 26,000 shares times $7 par, or 182,000. And then our debits always have to equal our credits, right? So then we have a debit, or I'm sorry, credit to paid in capital in excess of par for common stock equal to $436,000. Exercise 11.5. So on June 30th, Sharper Corporation's common stock is priced at $62 per share before any stock dividend or split, and the stockholder equity section of its balance sheet appears as follows. So assume the company declares and immediately distributes a 50% stock dividend. The events recorded by capitalizing retained earnings equals to the stock's par value. Answer these questions about the stockholder's equity as it exists after issuing the new shares. So question 1 is to complete the table to calculate how retained earnings balance total stockholders' equity and number of outstanding shares. So before the dividend, they're just transferring down all the information from above. And then the impact of the dividend. A 50% stock dividend is going to increase our common stock by 50% of what exists today. So 50% of 250 is 250,000. So after the stock dividend, we have $750,000 in our common stock account. Paid in capital doesn't change after. Total retained earnings is going to be reduced by the impact of the stock dividend. So we're going to decrease our $660,000 by 250 to get 410. So our stockholder equity total balance doesn't change. Our number of shares outstanding is going to increase by 50%. So we have 25,000 that's going to be added to that original 50 for a total of 75,000. Okay. Okay, so same problem here. Different numbers. Why don't you take a few minutes, complete the table before and after the stock dividend, and when you're done, you can resume the recording and we'll go through the answers. All right, so on June 30th, Sharper Corporation common stocks priced at $30.50 before any stock dividend or split. The equity section of their balance sheet appears as follows. Assume the company declares and immediately distributes a 100% stock dividend in the events recorded by capitalizing retained earnings equal to the stock's par value. Answer the questions about the stockholder equity as it exists after issuing the new shares. So before the stock dividend, you're just bringing down everything from up above here, right? And then 100% stock dividend. Oh wait, hold on. Number of shares outstanding, 32,000. We pick that up from right here. All right, so before the stock dividend, there's all of our information. If they distribute a stock dividend immediately, we're going 100%, we're going to add an additional 32,000 shares. We're going to reduce our retained earnings by 256,000, and we're going to double our common stock by 256,000. So we've got, after the stock dividend, $512,000 of common stock. Nothing happens to paid in capital. Our retained earnings goes down by 256,000 to 102. And our total stockholders' equity does not change. It's just transferring from one bucket to the other. And the number of shares outstanding is now 64,000. All right, 11.6. Stockholder equity for TVX Company at the beginning of the day on February 5th is as follows. On the 5th, they declare a 20% stock dividend distributable on February 28th to the February 15th stockholders' record. The stock's market value is $40 per share on February 5th before the dividend, and the stock's market value is $33.40 per share on February 28th. So prepare the entries to record both the dividend declaration and its distribution. So on the day they declare it, the 20% stock dividend, there's 60,000 shares outstanding times 20% means they're going to issue 12,000 shares at that market value of $40. So we're going to reduce our retained earnings by 12,000 times 40. And we're going to record a liability, common stock dividends distributable, at the par value, which is $10 per share. They tell us that right here. So $10 times 12,000 shares is 120,000. And the difference is going to be to paid in capital in excess of par. And that's because this is considered a small stock dividend. So less than or equal to 25%. So we need $360,000 credit to our paid-in capital account in order to have our debits equal our credits. Then on the 28th, when they distribute it, we're gonna reduce our common stock dividends distributable. We're gonna reduce our liability account by that 120,000, and we're gonna increase our common stock for the additional 12,000 shares that we issued at the $10 par, 120,000. All right, so in the second part, one stockholder owned 800 shares before the February 5th dividend. Compute the book value per share and the total book value of the stockholder shares immediately before and after the dividend. So the book value before would be our total stockholder equity, 1,575,000 divided by the total 60,000 shares that are issued and outstanding. So our book value before is $26.25. The number of shares that this particular shareholder owned before the dividend was 800. So their value before was 26.25 times 800, or $21,000. The book value after, so we started with 60,000. We issued another 12 from the previous slide, so we have 72,000 shares, but our total stockholder equity isn't changing, so our book value after is $21.87.5. And now he's got 960 shares. So if you take 800 shares times 20% for that particular stockholder, you should get 800 times 1.2. He has 960 shares after. That's an additional 20% of his 800 he originally had. 21.875 times 960 shares. The book value per share is still $21,000. So the point is because the total value in stockholder equity doesn't change, the total value of the total book value of the shares that each shareholder has doesn't change either. It's just the per share value that changes when you do a stock dividend. Okay, it's this number. Well, and the number of shares, but the point is the totals don't change for the shareholder, nor do they change for the company in total. Okay? All right. Then in number 3, compute the total market value of the stockholder shares immediately before and after the dividend. So the number of shares owned before the dividend was 800. The market value on February 5th was $40. 800 times 40 is 32,000. After the dividend, he owns 960 shares. The market value they told us in the previous problem was, or in the previous slide, was $33.40. So it's $32,064 after the stock dividend. Okay. All right, so same problem, different numbers. Why don't you take a try at it? And when you are finished, you can resume the recording and we'll go through the answers. All right, so stockholder equity TBC beginning of the day on February 5th is as follows. This time they declare a 12% stock dividend on February 28th to the February 15th stockholders of record. Market value before is $40 per share. Market value after is $35.71. What's the journal entry? So a 12% stock dividend is a small stock dividend. So we're going to reduce our retained earnings for the number of shares times the market value. So in this case, there were 68,000 shares outstanding. So take that 68 times your 12% stock dividend. You're going to issue another 8,160 shares at the market value of $40. So we're going to reduce our retained earnings by $326,400. We're going to record our common stock dividend distributable. That's our liability. We're going to record that at the par. So they tell us that the par value is $25. So we're going to take 8,160 shares times $25 for $204,000. And the difference goes to our paid-in capital in excess of par, $122,400. Then when we pay it, we're going to reduce our common stock dividend distributable liability. We do that with a debit. And we're going to recognize the additional common stock that we've issued at the par value, 8,160 shares times $25 par. All right, in part 2, they want you to compute the book value per share and the total book value of the stockholder shares immediately before and after the stock dividend. So why don't you pause the recording, take a minute to do that, and then resume the recording and we can go through the answer. All right, so before there were $3,808 total stockholder equity. There were 68,000 shares. So the per share value, book value per share, $56, excuse me. The number of shares this stockholder owned is 600. They tell us that right here. So we've got the total book value before of $33,600. And then after, where we've got 68,000 times that 12%, right? So we added $8,160 or 8,160 shares to our total shares outstanding when we did the stock dividend. So now we have 76,160 shares, but our total equity does not change. So our book value per share is $50 now. The number of shares this stockholder has, if he got 12% additional shares, is $600 times 1.12, or 672 shares now. So the book value per share, or the total book value after the stock dividend, is unchanged, right? Because what happens is the number of shares goes up and the value per share goes down. Okay. All right, in part 3, they want you to compute the total market value of the stockholder shares immediately before and after the stock dividend. So take a minute, do that, and when you're done, resume the recording and we'll go through it. All right, the number of shares before the stock was 600, they told us. The market value per share on the 5th, they told us, was $40. Oops, thought I had my highlighter there. It was $40. So 600 shares times $40. The market value before was $24,000. The market value after, we said they had 672 shares after, right? And they tell us the market value is $35.71. Market value after is $23,997. Okay? All right, exercise 11.8. York's outstanding stock consists of 80,000 shares of non-cumulative 7.5% preferred stock with a $5 par and 200 shares of common stock with a $1 par. During its first 4 years of operation, the corporation declared and paid the following cash dividends. So they want us to determine the amount of dividends paid each year to each of the two classes of stockholders, preferred and common, and then the total dividends paid for each of the 4 years combined. So our annual preferred dividend, they tell us, is our par value for the preferred share, sorry, is $5. They tell us the rate is 7.5% for preferred stock. So if you take $5 times 0.075, that means the dividend per share is 37.5 cents. I'll write that in. This is a divide by sign. That's not really that great, but, and then this is equals. So $5 divided by 7.5%, okay? So the number of preferred shares, they tell us, is $80,000. So that means our preferred dividend every year is $30,000. 37.5 cents times 80,000 shares gives us $30,000. Okay? So it's non-cumulative, and the cash dividends paid in year one is $20,000. So those paid to preferred is going to be all $20,000 because preferred get paid before common. So paid to preferred is $20,000 and paid to common is $0. That's because we should be paying our common stock or our preferred stockholders $30,000 every year. So we paid 20, all 20 goes to preferred. We have no dividends in arrears because it's non-cumulative. Okay. In 2017, we paid $28,000 dividends. All 28 again is going to go to the preferred stockholders. We're going to pay 0 to common. And we don't have any dividends in arrears because that's non-cumulative. In 2018, we paid $200,000. So we're going to pay $30,000 to our preferred stockholders, and we're going to pay $170,000 to our common. 0 dividends in arrears. In 2019, we paid $350,000. So we're going to pay all 30 to our preferred, and we're going to pay $320,000 to our common. No dividends in arrears because it's non-cumulative. So our total dividends paid is the sum of that 4 years, $598,000. That's just coming from up here. We paid $108 to our preferred, and we paid $490 to our common. All right, so same problem. Why don't you determine the amount of dividends paid to each of the stockholders in each year, and then also the total for the years combined. All right, let's go through it. So our par value for preferred shares, $10. They tell us that up here. Our dividend rate is 7.2%. So our dividend per share, 10 divided by 7.2% is 72 cents per share. And we have 50,000 shares of non-cumulative preferred stock. So our preferred dividend every year should be excuse me, $36,000. Then figure out how much goes to each year. So in 2016, we paid $22,000 of dividends. We're supposed to be paying our preferred 36 every year, so all 22 goes to preferred and 0 to common. No dividends in arrears because it's non-cumulative. In 27, we paid $29,000. All 29 is going to go to our preferred, 0 to our common, and our dividends in arrears is going to be 0 because it's non-cumulative. In 2018, we paid $90,000, so we're going to pay our preferred shareholders $36,000. The remaining $54,000 will get paid to our common. We have no dividends in arrears. And then in 2019, we have $58,000 that we paid total. So $36,000 gets paid to our preferred. The remainder gets paid to our common, so that's $22,000. No dividends in arrears again because it's non-cumulative. If you sum them up, we paid total $199,000 worth of dividends over the 4 years, 123 of which got paid to our preferred, and $76,000 to our common stockholders. Okay, so hopefully you found that to be pretty easy. Exercise 11.9. So York's outstanding stock consists of 80,000 shares of cumulative 7.5% preferred stock, $5 par, and $20,000 shares of common stock with a $1 par value. So it's the same type problem, it's just this time it's cumulative. That's the difference. So let's see how that works. So our preferred dividend's $5. Our rate is 7.5%, so our dividend per share is 37.5 cents. We have 80,000 shares issued, so our dividend is going to be $30,000. So this is exactly the same as the one that we did together 2 slides ago or so. except for the difference is it's cumulative. So in 16, when we pay that $20,000 cash dividend, we're going to pay $20,000 all to our preferred. We're going to pay 0 to our common. That's the same as if it was non-cumulative. The difference is, though, we have $10,000 of dividends and arrears because we owed them 30, but we only paid them 20. Okay. In year 2, when we pay the 28, we're going to pay all 28 to our preferred, 0 to our common. Same exact thing would happen under non-cum. The difference here is that we've now got $12,000 of dividends and arrears in year 2. We've got the additional, we have the 10 from 2016 plus an additional 2 because we paid them 28, but we owe them 30. So we now have $12,000 of dividends and arrears. Then in 2018, we paid $200,000. So what we're going to pay to our preferred shareholders is the annual of 30 plus the 12 that's in arrears. So we're going to pay them a total of 42. And then the net, what's left over, is going to get paid to our common shareholders, $158,000. So now we have 0 dividends and arrears because we caught it up, right? 2019, we paid $350,000 of dividends. So we're going to pay 30 to our preferred shareholders, and we're going to pay the remaining $320 to our common. And we have no dividends and arrears. Okay? So we paid a total of $598,000 of dividends, 120 of which got paid to preferred, 478 to common. So same problem, different answers here, or same problem, different numbers rather. So why don't you take a few minutes and determine the annual dividend and then the amount paid to preferred and common shareholders each year, assuming that it's cumulative instead of non-cumulative. All right, so hopefully you found this to be easy. Let's walk through it. So the par value per preferred share is $10. They tell you that. The rate is 7.2%. They also tell you that. So $10 divided by 7.2% is dividends per share of 72 cents. We have 50,000 shares outstanding. They tell you that right up here. So your preferred dividend each year should be $36,000. So that's the same as the one that you did on your own just a few minutes ago. So in 16, when we pay $22,000 of cash dividends, we're going to pay all 22 to our preferred because we owe them 36. We're not going to pay anything to our common shareholders, but we have dividends and arrears of 14 because we owe them 36, but we only paid them 22. Then in year 2, we paid $29,000 of dividends. So all 29 is going to get paid to our preferred shareholders. We had 14,000 in arrears before. Now we have an additional 5,000 or 7,000 in arrears. So we have a total of $21,000 of dividends and arrears. Then in 18, we have $90,000 that we paid. So we're going to pay our $36,000 to our preferred shareholders plus all 21 that's in arrears. So we're going to pay them $57,000. We have no more dividends and arrears, and we're going to pay $33,000 left, what's left over, to our common shareholders. Then in year 4, we have $58,000 of cash dividends paid. We're going to pay $36,000 to our annual, to fulfill our annual obligation to our preferred shareholders, and then the rest that's left over is going to get paid to our common shareholders. Okay. So we have a total of $199,000 of dividends paid, 144 of which went to our preferred shareholders, and exercise 1110. So on October 10th, the stockholders' equity of Sherman Systems appeared as follows. They want us to prepare the journal entries for the following transactions. So in letter A, we purchased 5,000 shares of our own common stock back at $25 per share. So when we buy our own stock back, it's called treasury stock. And it is a contra equity account. And so in order to increase our contra equity account treasury stock, we're going to debit for the cost that for what it cost us to buy those back. So that's 5,000 shares times $25 per share. So we have a debit of 125 and a credit to cash for 125. Then in letter B, we sold 1,000 of those 5,000 shares that we bought back on November 1st, and we sold them for $31 cash per share. So we sold them above the cost that they were to us. And so we're going to receive cash equal to the $31 per share we sold it for times our 1,000 shares. We're going to decrease our treasury stock account for the number of shares times the cost that those shares were to us. So $25 per share is what they cost us times the 1,000 shares. And then we have paid in capital treasury stock for the difference of $6 per share times the 1,000 shares. Okay. So then in letter C, when we sell all the remaining treasury shares, this time we sold them for less than what they cost us. So we're going to record cash equal to the $20 times 4,000 shares. We're going to reduce our treasury stock for the par value of the remaining shares. So that was $5 cost. Should be 25,000. So our 25,000 are 4,000 shares times $25 per share. They have the cost wrong here. This should be 25. So our treasury stock we're going to reduce for the cost that it was to us. So that's our 4,000 shares times $25 or $100,000. We're going to reduce our additional paid in capital treasury stock for as much as we have in it, but there's only $6,000 there. So we just reduce it from the available balance of $6,000. And then the remainder is a reduction to our retained earnings so that our debits equal our credits equal to $14,000. All right, so same problem, different numbers. Why don't you take a minute, see if you can record the journal entries, and when you're finished, resume the recording and we can go through the answers. All right, so in letter A, we purchased 4. All right, so when we purchased the 4,000 shares of our own common stock back at $20 per share, we're going to record our treasury stock, which is a contra equity account. To increase that, we debit. So 4,000 shares times $20 cost, it's $80,000 debit, and we're going to record the cash going out the door. To buy back those shares, $80,000 credit. Then in letter B, we sold 1,000 treasury shares on November 1st for $21 per share. So we're going to record our cash that we received, $21 per share times 1,000 shares, $21,000. Our treasury stock, but we're going to record our reduction in treasury stock at our cost, not the price we sold them at. So that's going to be 1,000 shares at $20 per share, right? In letter A, they told us we bought them back for 20. So that's $20,000 reduction in treasury stock to reduce treasury stock because it's contra equity account, we credit. And then we have paid in capital treasury stock, $1,000. Okay. Then in letter C, when we sell the remaining shares, so we had 4, we sold 1, we have another 3,000 left. 3,000 shares times $18 per share. We're going to have a debit of $54,000 to our cash account. We're going to reduce our treasury stock for the remaining 3,000 shares we sold, or $60,000. So we started at 80. We sold 20 on November 1st. We're selling the other 60,000 worth November 25th. Then we reduce our paid in capital for whatever's available. So we had $1,000 there from the letter B transaction. So we're going to take our credit balance of $1,000 in paid in capital. We're going to reduce it with the debit of 1,000. And then the difference goes to retained earnings. So because we sold the last 3,000 shares less than what they cost us to buy them back, we have a reduction in our retained earnings for the difference. Okay? All right, exercise 11. The following information is available for Amos Company for the year ended December 31st, 2018. We have a balance in our retained earnings account prior to discovery of an error of $1,375,000. We have cash dividends declared and paid of $43,000. We neglected to record 2016 depreciation expense of $55,500, which is net of $4,500 in income tax benefits. And then in letter D, the company earned $126,000 of net income. So what they want us to do is to prepare the statement of retained earnings. So we start with our beginning balance, which they told us was $1,375,000. Then we have the prior period adjustment, which is our depreciation error net of tax. So it's our $55,500 of depreciation expense that we didn't record. So that's going to reduce our net income, right? And thereby reduce our retained earnings, which is why it's a negative. So then we have adjusted retained earnings of $1,319,500. We're going to add our net income to it of $126,000. We're going to subtract our dividends that were declared and paid of $43,000 to get ending retained earnings of $1,402,500. Same problem, different numbers. Why don't you take a minute and prepare the statement of retained earnings. When you're finished, you can resume the recording and we'll go through the answer. All right, so we start with retained earnings of $865,000. They give us that in the problem, right? $865,000. I don't know why they're going in this order, but I guess in order of A, B, C, D, we have dividends of 25. We have a prior period adjustment where we didn't record our depreciation expense, $48,600. Adjust retained earnings, $865 less $48,600 is $816,400. Add our net income in letter D of $222,000. Should have ending retained earnings of $1,013,400. Exercise 1112. So Ecker Company reports $2.7 million in net income for 18. It declares $388,020 of cash dividends on its preferred stock for 18. And at the end of 18, it had 678,000 of weighted average shares of common stock. So what amount of net income is available for the common stockholders for 18? We had 2.7 million less preferred dividends. 388,020 means net income available to common stockholders is 2,311,980. In question 2, they want to know what the company's basic earnings per share is for 18. So we have our income available to common stockholders, which we calculated in number 1. Our weighted average shares, they tell us, is 678,000. 2,311,980 divided by 678,000. Our earnings per share is $3.41. All right, same problem, different numbers. Why don't you take a minute to compute the income available to common stockholders and then also the earnings per share. And when you are done, resume the recording and we'll go through the answers. All right, so Ecker Company reports $1,727,800 in net income in this example. They declare $310,000 of cash dividends on preferred stock, and then they tell us what the weighted average common shares are. So for the net income available to common stockholders, we have the $1,727,800 less the preferred dividends of $310,000 equals income available to common stockholders of $1,417,800. And then in number 2, we'll take our income available to common stockholders of $1,417,800, divide that by the weighted average shares of common stock, which is 340,000, they tell us. So we have a basic earnings per share of $4.17. Exercise 1113. So Kelly Company reports $960,000 in net income for 18, declares $120,000 of cash dividends on preferred stock, and they had 400,000 weighted average shares of common stock. So very similar to the last one, net income available to common stockholders is $960 less the dividends to preferred shareholders equals $840,000. And so same idea here. If the company's, what's the company's basic EPS for 18? Income available to stockholders, 840 that we just calculated, divided by 400,000, $2.10. All right, same idea. Why don't you take a minute, compute the income available to stockholders, common stockholders, and then also the earnings per share, and then we can go through it. All right, so our income is $1,899,500. We have cash dividends of $266,000. So our income available to common stockholders is $1,633,500. We have basic EPS of what is the company's basic EPS? We have the income available to common stockholders, 1,633,500 divided by weighted average shares of common stock, which they tell us are 330,000. So we have basic EPS of $4.95. Exercise 1114. So they want us to compute the price earnings ratio for each of these four separate companies. So we know that our price earnings ratio is the market value per share divided by the earnings per share. Okay, that's the definition of that calculation. So if we take our market value in company 1, 176.40, divided by 12 earnings per share, we have a PE ratio of 14.7. Company 2, $96 market value per share, divided by $10 EPS, it's 9.6. Company 3, 93.75 divided by 7.5, we have a PE ratio of 12.5. Market value per share is $250 for the company number 4, divided by 50, it's 5. So that, excuse me. So then they'd like to know what stock might an analyst likely investigate as being potentially undervalued by the market. Stocks with PE ratios less than about 5, anywhere between that 5 to 8 range, are viewed as potentially undervalued. So if the stocks above, the analyst might investigate stock number 4 as possibly being undervalued with a PE ratio of, that should say 5. Good grief, McGraw-Hill. All right, so same problem. Different numbers. Why don't you take a minute, compute the price earnings ratio for each of the 4 companies. And when you are done, resume the recording and we'll go through it. All right, so we said price earnings ratio is market value per share divided by earnings per share. So you should get 16 for company 1, 9.6 for company 2, 12.5 for company 3, and 5.8 for company 4. So in this case, which stock might an analyst investigate as being potentially undervalued by the market? Number 4, right? All right, exercise 1115. All right, so in this one, they want us to compute the dividend yield for each of the 4 separate companies. And dividend yield is computed by, oh gosh, I have the wrong heading here. Hold on. Ignore that. That should say dividend yield. Our dividend yield is the annual cash dividends per share divided by market value per share. So for company 1, they have cash dividends of 16.06, and their market value per share is $220. So that's a dividend yield of 7.3%. Company 2, 13.86 divided by 132 is 10.5%. Company 3, 3.96 divided by 72 is 5.5%. Company 4, 48 cents divided by $80 is 0.6% dividend yield. So which company's stock would probably not be classified as income stock? It's going to be the lowest one, right? The one that yields the lowest. So that would be company number 4. So that would probably be classified as a growth stock, not an income stock. Okay? All right, so same idea here. Why don't you take a minute and compute the dividend yield for each of the 4 companies. And then identify which company would likely be classified as not an income stock or as a growth stock. Okay. All right, so annual cash dividends per share divided by market value per share is the definition of dividend yield. And for each of the 4 companies, you should have gotten 7.7% for company 1, 9.2% for company 2, 10.8% for company 3, and 1.9% for company 4. And then which company stock would probably not be classified as income? Probably company 4, right? Sufficiently low that it would probably be classified as a growth stock. All right, exercise 1116. So the equity section of Cyrell Corporation's balance sheet shows the following. Preferred stock, 6% cumulative, $25 par, 10,000 issued and outstanding. Common stock, $8, $100,000 issued, or 100,000 shares issued and outstanding. And then retained earnings for total equity of $1,585,000. So what they'd like us to do is determine the book value per share of the common and preferred stock under 2 separate situations. If no preferred dividends are in arrears, our total stockholders' equity would be $1,585,000 divided by the equity applicable to the preferred shares. So you have $25 times 10,000 shares outstanding, $25 par value times 10,000 shares outstanding. And then cumulative dividends and arrears is 0. So if you take your total stockholder equity less your equity applicable to preferred shares, that gives you your equity applicable to common shares, right? We did that just a couple slides ago. So we have $1,335,000 of total equity applicable to common shares. So our book value for preferred stock is going to be our $250,000 value reported up top. So, oops, I almost drew on my screen. This 250 divided by the number of shares for preferred, right? So we have $25 book value for preferred. Our common, we used this number 1. We computed this to compute the book value of our common stock. So we have our $1,335,000 divided by our 100,000 shares that are outstanding. So we have book value for common stock of $13.35. Okay. All right, so then the second scenario is to assume that we have 3 years of dividends in arrears. So we have to figure out what our preferred annual dividend is. So we have our par value of our preferred stock, which was $25. Our dividend percentage is 6%. So that means our dividend per share is $1.50, and we have 10,000 shares outstanding. So our annual preferred dividend is $15,000. Okay. The number of years that are in arrears is 3, they tell us. So we have cumulative dividends of $45,000 in arrears for our preferred shareholders. So our total stockholder equity of $1,585,000 less equity that's applicable to preferred shares or being held for preferred shares. So we've got our preferred stock itself of $250,000. Also less our cumulative dividends of $45,000. So our equity that's applicable to common shares is going to be equal to our total stockholder equity less our preferred stock that's sitting on our books, our $250, less any cumulative dividends and arrears. And so in this case, that's $45,000. So our equity applicable to common shares is $1,290,000. So if we back up and compute the book value for preferred stock first, we have $295,000 divided by 10,000 shares. So that's our 250 plus our 45,000 that's in arrears, okay, divided by the number of shares. So our book value of preferred stock is $29.50. Our book value of common stock is then what we computed just a minute ago. Our equity applicable to common shares divided by the 100,000 shares, or $12.90. All right, so same problem, different numbers. Under scenario 1, assume no preferred dividends are in arrears. Compute the book value per share of preferred and common stock under each of the separate situations. And when you're done, you can resume the recording and we'll go through the answer. All right, so stockholder equity is 1,110,000 less our equity that's applicable to preferred shares. So we don't have anything in arrears, so we just take our 30 shares times our, or $30 times our 10,000 shares. So we have $300,000 of preferred stock. Cumulative dividends in arrears is 0. So we have 1,110,000 less 300,000 for a total equity applicable to common shares of 810,000. If we go back and compute the book value of preferred stock, it's our 30,000 or $300,000 divided by our 10,000 shares, so it's $30 per share. Our book value of our common stock is our 810,000 divided by our 45,000 shares that they tell us up here, or $18 per share. All right, so then under the second scenario, they want us to assume 3 years of dividends are in arrears. So the annual preferred dividend, first let's compute that. So we have par value of $300,000. Our dividend percentage is 6%. So our annual preferred dividends are going to be $18,000, and they tell us we have 3 years in arrears. So our cumulative dividends in arrears is $54,000. Then our total stockholder equity is 1,110,000 less equity that's applicable to preferred shares. So that's going to be our $300,000 par value plus our cumulative dividends in arrears. So we're going to have total stockholder equity less $354,000 for our equity applicable to common shares. Then, if we compute the book value of preferred stock, well, we have to consider the $300,000 they tell us up here, right? But also the dividends in arrears. So that's $354,000 divided by our 10,000 shares outstanding, or $35.40. And then our book value of common stock is going to be our equity applicable to common shares, which is $756,000, less the 45,000 shares they give us up above, for a total of $16.80 per share. Okay? All right, so that concludes the Chapter 11 exercises. So hopefully you'll find this to be helpful as you work through the homework assignment. But as always, if you have any questions, please don't hesitate to reach out. Thanks, guys. Take care. Unilever Group reports the following equity information for the years ended December 31st, 15 and 16 in euros. Oh gosh.